Your market news now. Global stocks rallied after China announced measures to support its ailing markets. But U.S. markets remained cautious ahead of economic data later. In addition, China Evergrande Group lost as much as 80% of its market value after its shares resumed trading, and a crucial step for the world's most indebted property firm as it seeks to restructure its offshore debt. Meanwhile, locally, tile and bathroomware manufacturer and retailer Italtile reported an overall slump in performance as trading conditions continued to deteriorate and home improvement projects became too expensive for consumers. To give us more perspective on the markets, we are joined by Roy Mutuni from Sanlam Investments. Roy, thank you so much for your time. Give us a sense of what you believe is dominating the market's attention right now.
Hi, Natasha. Thanks for having me. So markets are marginally up today, and what you're seeing is a little bit of a mix. I think the China-related stocks seem to be moving up, particularly the commodities, and it just seems that the market is happy that you can see China making an effort to stimulate its economy, and I guess hoping that this filters through to the stocks. As well, the fact that there was no new news at Jackson Hole probably means that markets basically are assuming an as-you-were stance. And from that perspective, less volatility and a little bit more of a positive direction.
Advotech released their results earlier this morning. What did you make of the interim figures? And I suppose let's add to that, what do you make of it as an education play, given the fact that you have exposure both to the school side and the tertiary division?
So this result was very much in line with what we saw with both Stadio and Curo the other day. Double-digit growth in revenue, widening margins, increasing cash flow. Schools and education just seem to be very good investments here, and I suppose that's a reflection on the failing state of the public sector in terms of education, and the fact that I guess parents see education as an essential investment for their children. So you're seeing it in primary school, high school, and in the tertiary sector as well, as the thirst for knowledge continues to grow. So solid result. I think there's solid momentum within these stocks, and it's definitely a sector that investors should be keeping a close eye on.
So post Jackson Hole and the comments that we got out of Fed Chair Jerome Powell, what do you then make of any recession risks for either this year or next year? Where does it sit now, given that perhaps even interest rates might have to stay higher for longer to deal with that inflation?
So the key conclusion from Jackson Hole was that it's too early to think about cutting rates. And in all likelihood, in some regions, the US and the EU and the UK in particular, rates may still need to go up. So that's clear. Places like Japan, rates are probably going to be relatively flat. But anywhere where you see rates going up, there's always a risk of a recession. Because typically what would happen is you hike rates, and you have to give them time to feed their way through the economy. And we're already seeing the impact of the higher rates in statistics in the US and in the UK. So what tends to happen is you hike too much, the economy really slows down, and that leads to a recession, which is what drives the cutting cycle. But I think all of these central bankers are unanimous in the fact that interest rates need to normalize, interest rates need to get to high enough levels, and inflation needs to come towards the target. It needs to hit the target average. In the case of the US, when they talk about 2%, remember it means that inflation needs to go below 2% so it could average 2%. So they'll remain aggressive, and I think that's a catchword for the next 6 months, for the next 6 to 12 months. High rates, and watch for inflation. The big risk here becomes growth.
Is that the same view you're having when you look at the Reserve Bank and your own assumptions when it comes to rates going forward?
So the Reserve Bank has to be cautious with regards to what it does, and it also needs to watch with the BDI what happens in the US and in global markets. It cannot afford to be completely separated from what happens there. It cannot, for instance, sit back and say there is no growth, so we're going to cut rates. What tends to happen is we're a small open economy, we need inflows of investments, and those inflows need to be attracted here by relatively high rates. So no, I really don't see much of a difference. I still think the stance is one of high interest rates, over the short to medium term, watching what happens both globally and domestically, because the worst thing you can do is move away from the global trend, which means let inflation rise. The currency will go, and then we'll have second-order effects, and inflation expectations become unanchored. So they will watch, they will keep rates relatively high, but they're definitely cognizant to the risks around weak economic growth domestically.
All right, Roy, I would have loved to have a conversation with you about, given this context that you've just described for us for both the South African and US market, where you are seeing opportunities, or at least sectors of the market that you are seeing opportunities. But we'll leave that conversation for another day. Thank you so much for joining us. That is Roy Muthuni, who is a portfolio manager at Sanlam Investments, giving us his perspective on the markets. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.